Okay. Hello, everyone, and welcome back to another episode of Tax Thursday, now on YouTube. I'm your host, Deedee Q, here with our Smart Counsel's tax resident attorney, Dionne Kellier.
Hello.
Happy Tax Thursday.
Happy Tax Thursday.
As you may have noticed, we are on a new platform, and that is YouTube. We're still in the process of transitioning and trying different recording mechanisms. So hang in there with us. We appreciate your patience, but you can always catch our live Instagrams or our episodes on our Instagram page, and just make sure you subscribe and follow us on all of our social media platforms. If you are new here, Smart Counsel is a woman-owned, minority-owned boutique law firm. Our attorneys are experienced in a variety of practice areas ranging from regulatory, strategic planning, corporate, and tax. You can head over to our website at www.smart-counsel.com to learn more about our attorneys and our firm as an overall business. In this new episode of Tax Thursday, we will be discussing Section 179 deductions for all businesses, whether small or large. And so to get started, Dionne, what is Section 179 and those deductions?
Okay, so I'm going to give you the IRS definition of what Section 179 deduction is, but what it relates to is, I know that everybody's been seeing these videos of, you can get a G-Wagon and you can expense it. So now we are going to discuss what that truly means. So the IRS says a taxpayer may elect to treat the cost of any Section 179 property as an expense which is not chargeable to the capital account. Any cost so treated shall be allowed as a deduction for the taxable year in which Section 179 property is placed into service. All right, so a couple of things about IRS definitions. They're not clear. So the IRS will use a term in the definition that you are trying to look up. So it's talking about Section IRS Code 179 is telling you about Section 179 property. Well, in your mind, you're like, well, what is 179 property? You have to dig a little more, and we will talk about it, during this session. So there's a dollar limitation. And then the next thing is the amount allowed as a deduction under subsection A, which is what I just read you, for any taxable year shall not exceed the aggregate amount of taxable income of the taxpayer for such taxable year, which is derived from the active conduct by the taxpayer of any trade or business. What does that mean? That means that whatever your Section 179 deduction is, it cannot exceed what your taxable income is. So that means if your business made $100, but whatever you bought cost $200, you are limited to $100 at most, but there are, of course, other limitations on Section 179. So, and it also has to be in the act of carrying on of any trade or business. So let me finish reading the definition before I even get into my whatever I have to say. So in the case of husband and wife, they'll be treated as one taxpayer for these purposes. So it's for the taxable income for your filing status. Like if you're filing jointly, it's not your income and their income, it's both of your incomes together. Taxable, meaning both of your incomes together having a taxable dollar. So you have to make a positive dollar in order to even utilize this section. And the limitation on cost taken into account for certain passenger vehicles. So in the cost of any sport utility vehicle for any taxable year, which may be taken into account, to not exceed whatever the number is. The definition, so I don't want to give you what the number is in the original definition, because when you go lower, it adjusts for inflation. So I'll give you what the number is today. So what does sport utility vehicle mean under Section 179 definition? Is primarily designed or which can be used to carry passengers over public streets, roads, or highways, except any vehicle operated exclusively on rail or rails, which is not subject to IRS Code 280F, and which is rated at not more than 14,000 pounds per gross vehicle weight. Certain vehicles are excluded. Those are ones that are designed to have seating capacity of more than 9 behind the driver's seat. Now they're excluded from a Section 179 deduction. Another is a vehicle that's equipped with a cargo area of at least 6 feet in interior length, which is an open area designed for use as an open area, but is enclosed by a cap and is not readily accessible directly from the passenger compartment. it's basically like a city bus. I mean,
Right. So anything, so pretty much you can deduct like any car other than like a bus or a charter semi,
exactly.
big cars.
So, right. And then let's talk about what 280F is, right? Because the definition above said that a sport utility vehicle is not subject to, in one of the definitions, is not subject to 280F. What is 280F? Limitation on depreciation for luxury automobiles and limitation where certain property is used for personal purposes. So depreciation, section 179 deduction is different than depreciation. And we're going to talk about what the difference is. But if you have a luxury vehicle or a vehicle that fits within this definition, you have certain limitations that you can deduct that you could depreciate. You're at a certain number limitation. And so I am going to talk about the difference, but first let's talk about this. Deduction, a section 179 deduction versus depreciation. So when you have depreciation, you're taking an item and you're placing it into what it's called service. When it's placed into service, you are allowed, prior to tax reform, they have certain class lives, and you are allowed to deduct based on the class life each year, whatever the prescribed amount is, whether it's by, you do the math, you divide it by 18, or whether it's, a certain number. So whereas a deduction is not depreciation, it's a full number that you can take right now. Well, so depreciation is a deduction, but it has it's almost like an installment deduction.
Right.
A 179 deduction is just fully a deduction, but there is something with depreciation that most people don't talk about, and it's called recapturing. So if you depreciate something, then when it's sold, the depreciation is allowed to be recaptured. And so that kind of determines what your basis would be when you sell it. I know it's going a little bit further than we wanted to, but that's the difference, kind of high level. All right, so the difference. So SUVs with a gross vehicle weight rating above 6,000 pounds are not subject to depreciation, including bonus depreciation limits. What is bonus depreciation? It allows the taxpayer to immediately deduct 100% of the item's full cost. So you don't have to worry about the class life. So like, for instance, there are things that have a 3 to 5 year class life. So you take whatever you paid for it, you divide it by 5, and that's how much you're able to deduct per year. Well, tax reform said that we're going to give you this thing named bonus depreciation, meaning you can deduct 100% in this first year, and you don't have to do it over the 5 years. So that's what bonus depreciation is. And section 179, it's kind of like you have to do either or, but for depreciation, you are limited to your taxable income. And with depreciation, you are limited to a number amount unless it qualifies for bonus depreciation. So vehicles over 6,000 pounds are not subject to depreciation or bonus depreciation limits, but they are limited to a section 179 deduction of $26,200. Okay. And no depreciation or section 179 limits apply to SUVs that are more than 14,000 pounds. And then if you are between 6,000 and 14,000 pounds, you generally have no bonus depreciation limits, but you have the 26,200 section 179 limit. And let's see, so the bonus depreciation, after this year, this tax year, in tax year 2023, that 100% bonus depreciation drops to 80%, and it phases out until tax year 2020, the end of tax year 2025, or the beginning of tax year 2026. So what is a vehicle that will qualify? It's not even all the SUVs. So Audi Q7. So anything under a Q7 would not qualify for this 100% bonus depreciation, but you can have the section 179 deduction. a BMW X5 or X6, a Buick Enclave, Cadillac XT5, 6, and an Escalade, a Chevy Silverado, Suburban Tahoe Traverse, a Chrysler Pacifica, Dodge Durango, and a Dodge Grand Caravan, a Ford Expedition Explorer F50 or larger, a GMC Acadia, Sierra, Yukon, a Honda Pilot or Odyssey, an Infiniti Q8 or QX80 or QX56, a Jeep Grand Cherokee, a Land Rover, Range Rover, or Discovery, so it could be a Range Rover Sport or a regular Range Rover, a Lexus GX 460 and LX 570, a Lincoln MXKT all-wheel drive and a Lincoln Navigator, Mercedes-Benz, G55, GLS, GLE, Metris, and Sprinters. That's why a lot of people have these Sprinter vans. A Nissan Armada, NV 1500, NVP 3500, and a Nissan Titan, a Porsche Cayenne, a Tesla Model X, and a Toyota 4Runner, Land Cruiser, Sequoia, and Tundra. So this is nothing new under the sun. However, you have to first, anything done for the purposes of avoiding lawful taxation is illegal. All right, so that's where we're gonna start. But if you have a viable business and you are utilizing the vehicle for more than 50% of the time in that trade or viable business, then you are allowed to take these deductions, whether this bonus depreciation existed or not, because these are expenses to your business. So like, I can't just, say, you know what, I'm going to start a lawn mowing service. And I go out and buy a G-Wagon. First of all, they're not going to give it to me. That's first of all.
Right, exactly.
And then second of all, like, if it is used in my trade or business, that's a little bit different. There are things where you capitalize, there are things that you amortize. And so of course you need to get with a tax professional that could tell you the difference, but like nothing that glitters is gold, right? They're not giving you G-Wagons for free, and you have to qualify as a viable business in order to even take advantage of these things that are available to everybody. You don't have to be special, to take advantage of this, but you do have to, it would be in your best interest to consult with someone who understands the difference and will take the ride with you and like doesn't want to, and they have to be, so you have to be a level of conservative when you're dealing with a tax person. So in my real life, am I a conservative person? No, I'm not. Tax-wise, I am very conservative because it's like there's nothing that is that beneficial to me that I would risk my freedom or my license, and especially the IRS, because it could always come back. So with this whole vehicle deduction, because I think there's also like other things that fall under this section 179, correct? Yes. So the vehicle has to be 50% used. Is that like you said, if there's an advertisement on the vehicle, or if you're like transporting things, or is it like I'm taking my car to work every day? So okay, good question. All right, so there doesn't have to be advertisement on there. That's just another example or another thing to support your case that this is you being utilized just for work, for my trade or business. Is it something you drive to work every day? Are you a business owner? Because that's really where it really makes a difference. Is it the vehicle that you drive to the business that you're owning? Yeah, better argument.
That makes sense. Okay, cool. And so it's kind of like a lot of the first business that comes to my mind is like a rental car, like a rental company, or like a party bus company, something like that. Would that not fall under?
No, it's totally different, right? Because those fall under that other definition where it says those that have the seating capacity of at least 9 behind the driver, or the vehicle has the cargo area. Though that's a totally different situation, because that is going to be a business expense, and those vehicles are going to be utilized in the business, and they're going to be almost like, I don't want to call it inventory, but they're going to be, they're not necessarily for like the business owner. They are utilized in making the money, right? Like exactly. So like, perfect example in how they have the delivery companies in Colorado that deliver the product and the money. Those would be one of the vehicles that you're talking about, like the party bus or like the, the whatever, like that is utilized in the business. And that is something that is going to be, it's almost like in the cost of goods, but this section 179 situation would be more applicable to the business owner.
Okay, that makes sense.
All right.
Wow. Sounds like there's like a lot of like loopholes, and like you said, you just need like a really good tax preparer on your side in order to like, because I don't think people knew about this until that Instagram video, TikTok video came out. And that's why people think it's like something new, and with people working from home and starting their own businesses, they want to take advantage of something like this.
And these are things that can be taken advantage of if you do it the right way. It's not even to be taken advantage of. Tax planning, proper tax planning is not illegal. If you have a business and this is something that can be utilized in your business, that's not illegal. Where it becomes illegal, right, or towing the line of illegal, is you've never had a business, you never owned anything. Now you're gonna go and you're gonna buy a G-Wagon and you're gonna be like, oh, I'm gonna expense it out of my LLC. Is a LLC your best choice? Like, there's so many questions where people come to me, it's like, oh, I want an LLC. You want an LLC for what? Do you know the difference between an LLC and a corporation and an S corporation? Like, I'm pretty sure you don't. And most people that are giving these pieces of advice, they are, and I'm not gonna knock their hustle, right? They are pulling information. This is almost like when I talk about tax preparers. I have nothing against tax preparers, right? You just need to be able to answer the next question.
Right.
And you want somebody that can answer the next question and can like think you through to the point of, if there's an issue, how they can resolve it. You don't want somebody that's going to throw up their hands and be like, oh, well, figure it out, because it happens.
Yeah, no, for sure. Yeah, that's like another thing that I keep seeing on social media is like, yeah, especially people around my age who are, just or younger, they like have their own business. They're like, I'm probably going to go to jail because I literally deducted everything on my taxes. It's like, well, we should probably make the investment in someone that can help you with that and think through all those scenarios. Like, what if this happens? What if that happens? Versus, like you said, kind of throw their hands up and be like, well, good luck to you.
And that's what happens, because people get involved in situations. And yes, you can Google anything. Anything is Googleable, right? But you want somebody, so I can tell you what a section 179 deduction is, right? But I can read the definition, anybody can, but can somebody explain it to you? Because the definition uses the term in there. So, section 179 property can be deductible, but what is 179 property? That's what we want to know. And then, does this qualify as 179 property, or does this qualify as another type of property? Is this section 267? Does it go better in 267? And let's not even get into the marijuana industry,
right?
Because if you, to make a mistake in the marijuana industry, as far as doing your taxes, like, it's a fatal mistake. Yeah. Because backing out of it and getting back on the IRS's good side it's going to take money and time.
No, for sure. So what else can you tell us? Like, I know you kind of spoke briefly about like the limits, the maximums. Can any size business do this section 179 deduction?
Any size business can. So let's see. Okay, so section 179. So any size business can do it. If you have a business, you are allowed to take advantage of whatever deductions that are available possible. And for small businesses, they have another section, right? And I want to say it's 471 I think it's 471. But I don't even like to talk about it, because people that are in the marijuana industry are trying to take advantage of this particular small business section, which basically takes your cost of goods and rolls it all into this one section. And the IRS knows that this is happening, and they're still sending notices of default. So notices of deficiency, excuse me. Be very careful with what section that you utilize, and make sure that if you're going to do it on your own, you read every section that is, because every section references another section, and you need to know how it all plays out in the end.
Right. Be able to navigate that for sure.
Exactly. And listen, sometimes I read it and I'm like, wait, let me get my paper out. Okay, all right. So this is going to refer to this. Let me go read this section, and then now I need to go back and apply what I just read, because talking about a section 179 property in trying to define what section 179 deduction is. It helps me none.
No, seriously, that's how the IRS website is. Like when I do my research, it'll give you a definition and there's a link to like a definition within a definition. By the end of my research, I have like 5 tabs open from like that initial search.
Yeah, because you can't skip it because it's so critical and so important. And it's not even like they're trying to be confusing. It's just that it is you have to wrap your head around the whole thing. And to wrap your head around the whole thing, you have to go down the ladder.
Right, exactly, for sure.
All right, so let's see. Okay, so section 179 allows taxpayers to deduct the cost of certain properties as an expense when the property is placed into service. Placing into service means that you're saying you are letting the IRS know, hey, I just got this property and I am placing it into service so that I'm gonna make these deductions. So whatever back research IRS that you wanna do, here it is on a beautiful piece of paper. This is everything that I am trying to depreciate or that I'm going to capitalize the expense. Okay. It applies to tangible personal property such as machinery and equipment used for you purchase for the use in a trade or business. And if the taxpayer elects qualified real property, and let's see, the tax reform amended the definition of some qualified real property to also include improved property and some improvements such as roofs, heating, ventilation, and air conditioning, fire protection, alarm systems, and security. It is an immediate expense deduction that business owners can take for depreciable equipment instead of capitalizing and depreciating the asset over a period of time, which is, basically I explained that without giving you the IRS definition, but this is officially what the IRS is saying. And it can be taken if the piece of equipment is purchased or financed and the full amount of the purchase price is eligible for a deduction. It allows businesses to lower their current year tax liability rather than capitalizing the asset and depreciating it over time in future years. And taking the cost of the equipment as an immediate expense allows the business to get immediate deduction. Let's see, it's limited to items such as cars, office equipment, business machinery, and computers. And equipment, vehicles, and other software purchased under section 179 must be used for business purposes more than 50% of the time to qualify for the deduction, and simply multiply. There's a formula to it, but I'm gonna say this. If you're gonna utilize this depreciation, and especially for the G-Wagon, I'm gonna say you wanna hit that 75–80% of the time that you're utilizing the vehicle for business purposes. The section 179 deduction for 2022 is 1.08 million for a piece of equipment and 2.7 million for all the equipment that you purchase in that year.
Wow.
All right. Planes, private planes. That's what, so.
Wow.
None of this tax reform did not include self-dealing. So private jets are definitely included in this new
really?
So it's not that they were not included before, but you would have to capitalize it over the class life. Now you can literally depreciate, or you could take the bonus depreciation in 1 year on your private jet that you buy. If your business is making 5 million and your jet costs 4 million, then now you only have $1 million worth of taxable income as opposed to 5 million, because you're netting your expenses against your income. Not a bad deal. Can you afford a private jet? That's the bigger question.
Let me know.
Listen, my goal is private jets and bungalows. That's what I'm trying to take advantage of.
So with each of these like purchases, do they have to be paid in full in order to these so you can like do these finances like on your G-Wagon and still?
Yep.
Wow.
You can finance and new to you. Doesn't need to be new, but it needs to be new to you.
Yeah, that's gonna be another question of mine.
So it has to be new to you, but it can't be purchased from like your mom or your father or your sister or your brother, right? It needs to be right. So everybody in the family is not going to take advantage of depreciation on one vehicle, right?
Sense. Okay.
So let's see. It expands the definition of 179 to elect to include the following improvements to non-residential property, so basically business making property. Qualified improvement to the building's exterior, so the enlargement, elevator or escalator, or the internal structural frame, roofs, HVAC, fire systems, alarm, and security. Let's see. So this is what you cannot do. The taxpayer or its predecessors didn't use the property at any time before acquiring. So the definition of property for 100% bonus depreciation was expanded to include used qualified property acquired and placed in service after September 27th, 2017, if all of the factors apply. The taxpayer or its predecessors didn't use the property at any time before acquiring it. The taxpayer didn't acquire the property from a related party. The taxpayer didn't acquire the property from a component member of a controlled group of corporations. That's just a related party that you're not like related by blood, but you're related by business. And if we talked about attribution several tax Thursdays before, that would apply. The taxpayer's basis of the used property is not figured in whole or part by reference to the adjusted basis. The taxpayer's basis of the used property is not figured under the provision for deciding basis, and it was acquired from a decedent. And the cost of the property eligible for bonus depreciation doesn't include the basis for property. It doesn't include somebody else's time period for holding it. That's basically what that means. It also added qualified film, television, and live theatrical productions as types of qualified property that may be eligible for bonus depreciation. And under the new law, certain types of property are not eligible for bonus depreciation in any taxable year beginning after December 31st. And one such exclusion from qualified property is for property primarily used in the trade or business of the furnishing or the sale of electrical, energy, water, or sewage disposal services, gas or steam through a local distribution system, or transportation of gas or steam by pipeline. And the only reason why it doesn't apply to that is because there's other advantages that those three things can, the other tax codes that those three things can take advantage of.
Right. Okay. That makes sense.
Let's see, the exclusion applies if the rates are approved. All right, we'll go to the next thing. And almost all types of business equipment that your company buys or finances will qualify for the Section 179 deduction. And it applies for your tax year. So it's equipment, it's computers, it's software for your computers, office furniture, office equipment, property attached to your building that is not a structural component of the building. So a printing press, or, for people that make clothes, large manufacturing tools and equipments, partial business use, equipment that is purchased for business use and personal use. Generally, your deduction will be based on the percentage of time you use the equipment for business purposes. And that's going to fall on the taxpayer to prove that you're utilizing it that 80% or 50% of the time. And it qualifies whether new or used, purchased outright, leased, or financed. And COVID and Section 169, all of those things you are able to utilize the Section 179 deduction. So when you had to put up those temperature checks, those sanitizing stations, the dividers and the plexiglass, the new signage, anything that you use to be like, hey, we're COVID compliant, or to be COVID compliant, like they have all those glasses, whatever, all those things that are being taken down now, you were able to bonus depreciate it. So yeah, Section 179.
That's very interesting. I'm just kind of baffled. I feel like a lot of people don't know about all these depreciations, deductions that you can do,
They don't know about it. Most people don't know about it. Most young people definitely don't know about it. Between 21 and 45, between 21 and 50, most people of color definitely don't know about it. And if you don't do tax stuff, you don't know about it, you don't care about it, you just drop your tax information into, whether it's the big box stores, and not that they don't ask you, because when I did TurboTax, they would ask you these things, but you're like, yeah, no, yes.
Okay. Yeah, now we have to pay attention.
Pay attention. See somebody like me, right? As I said, I enjoy talking about this tax stuff. I mean, it's not free, right? I'll say that, but it's an investment into your future, because once you meet with somebody like me and I give you a tax plan and we kind of know what direction you're going in, now when you go to your CPA or tax preparer, or you do it yourself, you're like, hey, wait a minute, what about this? Hey, wait a minute, what about that? And the fact that you even have the information is like a blessing to you, because there's a lot of people that don't know. I mean, I would guarantee that, most people don't take, only people that have tax planners and tax attorneys typically take advantage of these kind of things because like, you don't know. And I'll say this, I don't do my own taxes. Why don't I do my own taxes? Because I'm definitely taking advantage of everything.
Right.
I need
as much as I
like,
can.
Exactly. That's like, no, Dionne. Yes, Dionne. This is where your taxable dollar starts. And this is where, your depreciation ends. So.
Right. Yeah. I mean, like even working with a tax preparer, they're just kind of like trying to push papers through sometimes, at least the ones that I've worked with. They don't even ask these kind of questions, They're just like, is this everything you have? And then off they go filing it.
And they don't ask because they don't know. And
right.
It takes somebody. And guess what? I'm not going to say all tax attorneys don't know this. It just depends on what area you're in, right? So if you're a tax attorney that focuses on like probate stuff, you're not even, you might have heard it when we did like survey of tax, but you don't really care necessarily. And so it's not a negative thing. It's just, you need to get the biggest bang for your buck. Mm-hmm. You need different people to do different things. And so you don't go to, the perfect example. I went to my eyebrow lady to do a facial.
Oh,
yeah. It turned out I wanted to jump off of that table because guess what? You can't do facials.
Yeah, no. Lesson learned. No, but seriously though, go to what their profession, what they're an expert in versus, like you said, trying to like hold on to your money, especially when it comes to your business. You got to do some sacrifices and put your money, where it counts. And especially when it comes to taxes, no one understands taxes. I'm sorry. Like, unless you're a tax professional and that's your life, just like we were saying, like the eyebrow lady, like, it's just not a lot of people know about this stuff. And the IRS doesn't make it easy to understand, unfortunately.
Yeah. And that eyebrow situation is the best example I could give because I fell victim to it, right? I went to somebody who doesn't do that. I'm like, oh, I mean, you said it, you offered it, why not? And like literally I wanted to jump off the table in the middle. Yeah. And she did a great job with my eyebrows, right? But like, I want you to use all the stuff on my face. I want you to extract. I want my skin to be like, like all of that.
Not just a face mask.
That's exactly, it was 7 face masks. That was literally the worst. Like if you slap one more product on my face and you're not extracting, I'm gonna scream. So perfect example. Do not go to the eyebrow lady for facials. Go to the facial lady for facials. Facial lady or man or they or them.
Exactly. And so I guess that would be the takeaway from this episode, right? Is to make sure you know who you're working with, they're an expert in what they're doing. You guys now know, sorry, there's a fluff. Now you guys know about Section 179. And so, kind of question your tax expert, your tax preparer, your tax attorney, and see what they can do for you.
Yeah, and that's absolutely right. And yes, you can, if you have a viable business that's making money, if you buy a G-Wagon, that is a business vehicle. Yes, you would be able to take advantage of certain sections of the tax code, but nothing in life is free. Right. And you can't just buy a G-Wagon and start an LLC and then make the deduction. It's not going to happen.
Yeah, I think that's the biggest takeaway, especially because of that video on YouTube or on Instagram that's getting everyone all crazy.
It's because somebody has a little piece of information, but like they need to flesh out the information. Like this section alone, I did 20 slides on it. Right. 20 slides. So like, it's not as, yes, I just kind of broke it down easy. And this 30 minutes is still not enough. And like your particular situation would also change my analysis, right? Because if you're somebody who the IRS has declined, they've done a notice, they've audited your return and they've made certain corrections. If you're one of those people, you definitely, we got to look into your situation before we even try to take advantage of this section, because you have done something that has, made the hairs on the back of the IRS's neck stand up. So now you're definitely going to be audited again. And so if we don't have all of our ducks in a row, like you're going to be one of those people that are probably going to jail. And then you're going to make me probably, get some fines for helping you because I don't know your full situation. So, when you go to a tax person and when you are planning these things out, be open and honest, because like that is going to give you the best set of information.
Mm-hmm. Get with someone that you trust, just like with your eyebrows, your nails, you want to get someone that you trust, that you're able to have that open conversation with, so they can help you at their best, to their best ability. And I think that's a great point that you made. Every situation is different, is unique. So just because this may be perfect for company A, it may not be perfect for your company or your business.
Absolutely.
So awesome. Well, thank you so much, Dionne. This was a fun topic to cover, especially like I said, it's all over the internet. And so we can bring some clarity to that, some more understanding to everyone that's going crazy in the comments about it. And so if you guys have any questions or want to see a new topic here on our Tax Thursday episodes, feel free to DM us on Instagram, or you can email us at attorney@smart-counsel.com. And make sure you're following us on all social media platforms. We're everywhere: LinkedIn, Facebook, Instagram, and now on YouTube, like I said. Otherwise, we will see you guys on our next Tax Thursday episode.
Perfect. Thank you, Deedee. Have a wonderful day.
Bye.